Welcome to the deep dive. We're really thrilled to have you with us today because we are tackling a concept that is just surrounded by so much
Oh,
noise.
definitely. A lot of noise out there.
Right. And our mission today is to cut straight through it. We have got a massive stack of sources on the table for you. We are pulling from comprehensive tax guides, from financial heavyweights like Fidelity and Saxo Bank.
Mhm.
We've got a 2026 Excel tutorial on building a custom portfolio tracker. We're even reaching back to some academic commentaries from the 1960s. And we are pairing all of that with an incredibly detailed 35-year historical market study from Intelligent Capital Works.
It is a really fantastic stack of data.
It is, and our overarching goal for you today, what we really want to do is completely dismantle the internet hype around passive income. You hear that buzzword constantly.
Usually attached to someone trying to sell you a course online.
Exactly. But today, we are giving you a masterclass in deliberate, strategic dividend growth investing. We're going to explore the raw mechanics of how money exponentially compounds over time, how to navigate the hidden tax traps that can just destroy your returns, and how to build a system that actually works for your long-term wealth.
That is the perfect way to frame it. The tone we really need to set right out of the gate here is analytical, highly practical, and cautiously optimistic.
Cautiously optimistic. I like that.
Yeah, because there is a profound night and day difference between a high-quality dividend that is genuinely backed by robust free cash flow and a financially engineered value trap.
Right.
Yield can be incredibly deceptive. So our job today is to help you separate the genuine signal from all that marketing noise so you can make highly informed decisions about where you actually park your capital.
I want to kick things off with a classic piece of wisdom. Albert Einstein famously called compound interest the eighth wonder of the world.
Yeah.
He supposedly said that those who understand it earn it and those who don't pay it.
A great quote.
But looking through this stack of research, especially that massive 35-year study from Intelligent Capital Works, it seems like compound dividends are essentially compound interest on steroids.
They really are.
It's not just a flat rate, it's a completely different level of exponential growth. So how does that math actually play out compared to, say, a standard high-yield savings account?
It's a completely different animal. With a traditional bond or a savings account, you are earning compound interest on a fixed principal, plus whatever interest has accumulated.
Right. It's just one engine.
Exactly. It's a single engine of growth. But a deliberate dividend growth strategy adds multiple simultaneous engines. You aren't just taking the cash and buying more shares. In a healthy company, the business itself is organically increasing its payout per share every single year. And the underlying shares are ideally appreciating in value.
So you have the share price going up, the actual cash payout going up, and you're buying more shares with that cash.
Precisely. To give you an idea of the math, the Intelligent Capital Works study laid out this brilliant theoretical model over a 35-year period. Imagine you take $100,000 and you lock it into a flat 3% compound interest rate.
Okay.
Over 35 years, that initial investment grows to a very respectable $281,000 in change.
Which is not bad, but it's not exactly buying a private island.
Whoa, it's not. But let's look at the alternative they modeled. You take that same $100,000 and invest it in a stock paying a 3% dividend.
Okay. Same starting yield.
Same starting yield. But here's the catch. The company grows that dividend payout by 3% annually. The stock price appreciates by just 3% a year. And you automatically reinvest every single dividend you receive back into the stock.
So everything is just compounding at 3% across the board.
Exactly. By the end of that same 35-year period, that $100,000 doesn't grow to $281,000. It grows to an astonishing $768,000.
Wow. That is nearly a $500,000 difference just by adding a moderate growth rate and reinvesting.
It is massive. And what's fascinating here is that gap perfectly illustrates a metric that I think is the single most important concept in this entire deep dive.
And what is that?
Yield on cost. This completely reframes how you look at income investing. Most people open their brokerage app, they look at a stock, and they see it yields 3% today.
Right. That's what's flashing on the screen.
But the true value of a long-term dividend strategy isn't what the stock yields on today's market price. It is what that dividend yields relative to the original cash you put out of pocket decades ago.
Because the company keeps raising the payout.
Exactly. As the company raises its dividend year after year, your cash paying keeps growing. But your original cost basis, the money you actually spent, remains exactly the same.
I remember reading an example of this in the sources that absolutely blew my mind. It was about Realty Income Corporation, ticker symbol O. Could you walk through those numbers? Because when I saw the math on that, it sounded almost illegal.
It really is a staggering case study in yield on cost. Let's say it's 1994, and you decide to invest $8,000 into Realty Income. In that first year, you would have received roughly $900 in income.
That is a fantastic initial yield. What is that, around 11%?
Just over 11%, yes, an 11.3% yield. But here is where the compounding engine really takes over. By 2016, about 22 years later, Realty Income had pushed through more than 75 consecutive quarterly dividend increases.
75 consecutive increases.
Yes. Now, imagine you haven't invested another dime of your own money since 1994. By 2016, that annual income on your original shares had grown to nearly $2,400.
Wait, let me make sure I'm hearing this right. So without buying a single new share out of pocket, you are making almost 30% on your original money every single year.
Precisely. You're earning nearly a 29.9% yield on your original 1994 cost basis.
Yeah.
And it gets even more dramatic if you look at total return.
If you had reinvested.
Yes. If you had taken those dividends and aggressively reinvested them into more shares along the way, a $100 investment in 1994 would have grown 27-fold by 2016.
That is just incredible. But it begs the question, how does a company actually afford to do that for decades? I mean, you can't just magically create cash out of thin air.
And that is the most crucial caveat of this entire strategy. A dividend is fundamentally an output.
An output.
Yes, it is the result of a successful business model. It is not the driver of the business. The only way a company can sustain that kind of relentless multi-decade payout growth is if it generates a massive return on invested capital. And it has to produce a growing mountain of free cash flow.
Because if the cash flow isn't there.
If the underlying business quality deteriorates, the cash flow dries up, and that dividend becomes a house of cards waiting to collapse.
So if I want to capture that kind of exponential growth and avoid the house of cards, what exactly am I looking for in the market? Because I know the dividend community has this whole royal court of terminology. You hear about dividend kings and dividend aristocrats. They sound like the same thing, but the sources make it clear they are completely different animals.
They filter out very different types of companies. Let's look at the dividend aristocrats first. This is an official index, actually maintained by S&P Dow Jones.
Okay.
To become an aristocrat, a company must have 25 consecutive years of dividend increases. But there's a massive secondary hurdle. They absolutely must be in the S&P 500, and they have to meet strict large cap liquidity rules.
So it's not just about the streak.
Right. That S&P 500 requirement is a brutal filter. It ensures you are only looking at massive, highly mature, dominant businesses. If a company shrinks in market cap and falls out of the S&P 500, they are stripped of their aristocrat title immediately, even if they are still raising their dividend.
And what about the dividend kings? I assume that's an even more exclusive club.
The kings have a singular, uncompromising hurdle: 50 consecutive years of dividend increases, period.
Half century.
Exactly.
Yeah.
Doesn't matter if they are in the S&P 500. Doesn't matter if they are a mid-cap stock flying completely under the radar. If a company can survive a half-century of major recessions, double-digit inflation, market crashes, and completely shifting consumer habits, all while raising its payout every single year, it earns the title of a king.
I have to push back on that a little bit, though. 50 years is a very long time. If a company has been doing the exact same thing since the 1970s, aren't they basically a corporate dinosaur? I mean, sure, the dividend is safe, but where is the growth coming from?
That is exactly the debate sophisticated investors have.
Yeah.
And it leads to what analysts call the sweet spot theory.
The sweet spot.
Yes. You might intuitively assume a 50-year king is always a better investment than a 25-year aristocrat.
Yeah.
And historically, kings offer unparalleled wealth preservation. They have these incredibly deep economic moats and very low volatility.
Right.
But to your point, because they are so old and their markets are completely saturated, their earnings growth might have slowed to an absolute crawl, maybe 1 or 2% a year.
Which doesn't beat inflation.
Exactly. So the sweet spot for maximizing your total return might actually be companies classified as contenders.
Contenders.
Yes. These are companies with 10 to 24 years of consecutive increases. They have survived enough market cycles to prove they are committed to shareholders. But their market share isn't maxed out yet, meaning they still have a runway to grow their earnings at 8 to 10% a year.
That makes total sense because longevity is clearly not a guarantee of safety. Look at 3M. It was in the sources as the classic example of a fallen king.
Oh, 3M is the ultimate cautionary tale.
This is a company that had an unbelievable streak of over 60 years of dividend increases. But if you bought 3M a few years ago solely because you wanted the safety of that 60-year streak, you got completely crushed.
You did. A 60-year streak breeds complacency in investors. But that streak didn't protect their capital when 3M was hit by billions of dollars in environmental and earplug lawsuits. And you combine that with shifting macroeconomic headwinds.
The dividend kept trickling in, but the stock?
The underlying stock price plummeted. The capital destruction vastly outweighed the dividend income.
Which really proves you have to look at the total return, not just the yield. But on a macro level, how does this deliberate dividend growth strategy actually hold up against the broader market over a long horizon? If I'm giving up high-flying tech stocks to buy these steady payers, am I leaving a fortune on the table?
Not according to the historical data. This is where that 35-year study from Intelligent Capital Works spanning from 1980 to 2015 is so illuminating. They created synthetic indices to test these exact categories against the broader market.
What were the results?
They found that an index of dividend growers or initiators advanced from a baseline of $100,000 to over $76.8 million.
Wait, $100,000 to $76.8 million.
Yes. That is a compound annual growth rate of roughly 20.9% over 3.5 decades.
That is staggering.
And the Dividend Aristocrats Index also performed brilliantly, growing that same 100K to over $30 million. But what's crucial here is that both of those groups vastly outperformed the S&P 500 average. And they absolutely crushed the indices made up of companies with sporadic dividend policies or companies that actively cut their dividends.
That kind of data is hard to argue with. But how do we know this isn't just cherry-picked data? Anyone can look back 35 years and pick the winners.
The academic rigor of this study is what gives it so much weight. They didn't just backtest perfectly in hindsight, they used adjusted close prices.
What does that mean in practice?
It is essentially a financial methodology that simulates the real-world reality of dividends, reducing the cost basis of the stock when paid out. Furthermore, they phased companies in dynamically.
So they didn't just pretend you could buy a 1990 stock in 1980.
Exactly. Take a company like Jacobs Engineering. They added companies to the data only when they actually became publicly available. They didn't artificially backdate anything.
That definitely adds credibility.
And the biggest takeaway from all that rigorous modeling was how these stocks performed during crises. During the Black Monday crash of 1987, or the 2008 financial crisis, the dividend acted as a built-in shock absorber.
A cushion.
Yes, it provided structural support to the stock prices of these robust payers, while non-dividend paying growth stocks went into freefall.
If dividends are this incredible cushion, I have to ask about a glaring contradiction I saw in the sources.
Okay.
Okay, let's unpack this. I'm looking at a list from Sure Dividend, and they highlight a mortgage REIT Orchid Island Capital. It's paying an eye-popping yield of nearly 20%, 19.5% to be exact. Why shouldn't I just take my entire portfolio, dump it into that REIT, and retire tomorrow on that massive cash flow?
Because that is the absolute definition of a yield trap.
Yeah.
Now, to be fair to REITs, real estate investment trusts, they operate under very specific rules. They are legally required to distribute 90% of their taxable income to shareholders every year just to avoid paying corporate taxes.
So that naturally bumps up the yield.
It does naturally inflate their yield compared to a normal stock. But a 20% yield is almost always a blaring siren warning you to stay away.
Why is it so dangerous?
A yield that high usually signifies one of two things in the market. Either the stock price is already in a catastrophic freefall because Wall Street knows a massive dividend cut is imminent, or the company is artificially funding those huge distributions by taking on massive unsustainable debt.
So they're just borrowing money to pay you.
Exactly. You aren't buying a sustainable business. You are buying a mirage.
And even if that 20% yield was somehow real, there's a massive silent killer lurking in the shadows that we have to talk about. Taxes. Dividends are not free money falling from the sky.
Far from it. And the tax guide from Fidelity lays this out in sobering detail. The IRS essentially views dividends in two completely different ways. And the gap between them can absolutely savage your returns.
So,
When a company pays you a dividend, it is classified as either qualified or ordinary. Qualified dividends get extremely favorable treatment. They are taxed at long-term capital gains rates, which means, depending on your income, you might pay 0%, 15%, or a maximum of 20%.
That doesn't sound too bad.
It's quite favorable. But to get that treatment, the dividend generally has to come from a U.S. corporation, and you have to hold the stock unhedged for a specific holding period.
But what happens if it's an ordinary dividend, like from those high-yielding REITs we just talked about?
That's where the trap springs. If the payout is classified as an ordinary dividend, it is taxed exactly like the salary from your day job. For high earners, that means those payouts can be taxed at rates as high as 37%.
37%.
Yes. Suddenly, that massive yield you were so excited about
Yeah.
is getting a third of its value chopped off by the IRS before you can even reinvest it.
And the Fidelity Guide points out it gets even worse for high-income earners because of the net investment income tax, the NIIT.
Exactly. That is a 3.8% surtax that kicks in once you cross certain income thresholds. So your effective tax rate on even the favorable qualified dividends might jump to roughly 19% or nearly 24%.
That is a huge drag on compounding.
Which is exactly why account placement is a critical strategy. If you hold these high-yield, ordinary dividend payers in a standard taxable brokerage account, you are facing a brutal tax headwind every single year.
So where should they go?
If you place those specific assets inside a tax-advantaged account, like a Roth IRA or a traditional IRA, you can legally shelter those payouts from immediate tax consequences. Inside a Roth IRA, that compounding engine can run entirely unimpeded by tax drag.
That tax reality really changes the conversation around DRIPs, doesn't it? For the longest time, a dividend reinvestment plan was considered the holy grail of compounding. You bypass the broker, you automatically buy fractional shares, and you never even see the cash.
DRIPs used to be fantastic because they saved you from paying hefty commission fees on every trade. And sometimes they even offered a 5% discount on shares. But as the commentary from the successful investor points out, we live in a world of zero-commission brokers now.
Right. Trading is free on almost every major app.
So that fee-saving advantage is basically gone.
Oh.
And here is the psychological trap of a DBRIC: phantom income.
Phantom income.
Even if you automatically reinvest the dividend and never touch the cash, the IRS still considers it income in the year it was paid. You owe taxes on money you never technically pocketed.
Which naturally leads to the massive debate going on right now. Dividends versus stock buybacks. If a company uses its extra cash to buy back its own shares instead of paying a dividend, the share price goes up, your piece of the corporate pie gets larger, and you don't trigger a single taxable event. It's pure tax-deferred compounding.
It's a fascinating dynamic, and it directly connects to some classic academic work by Miller and Modigliani from the 1960s. They introduced a concept called the clientele effect.
Can you explain that like I'm 5? Because clientele effect sounds like a very dry economics paper.
Think of a company's financial policy like a political party trying to attract a specific demographic of voters. Companies organically attract specific clienteles of investors based entirely on their tax brackets.
So they draw in the people who benefit from their specific setup.
Exactly. In a tax jurisdiction that heavily penalizes dividends but favors capital gains, wealthy investors will flock to companies that exclusively do stock buybacks. Conversely, retirees who need cash flow and perhaps have lower income tax burdens will flock to high dividend payers. The company's policy acts as a giant magnet, pulling in a very specific demographic of taxpayer.
All right, let's bring this all down to earth. If I'm listening to this and, I want to start building this compounding engine tomorrow, how do I actually track it? Because if you don't treat this like a business, it's really just a hobby.
The 2026 YouTube tutorial we reviewed has a highly practical solution. You need to build a custom Excel tracking dashboard. And it doesn't have to be overly complex.
So what does this all mean? What actually goes into this tracker?
You start with a primary sheet called the portfolio sheet. This is your raw ledger. You log the ticker symbols, the exact number of shares you own, and the annual dividend payout per share.
Simple enough.
Once that data is in, you build a secondary dividend tracker sheet. The core function here is taking your total annual projected dividend and dividing it by 12.
Right, because turning an abstract annual percentage into a tangible monthly cash flow projection is incredibly powerful. The tutorial even recommended adding pie charts for your sector breakdown and line graphs to watch that monthly income climb.
Visualization is key.
Though I have to admit, once you build those charts, you start checking your spreadsheet every day like you're checking the fridge. Even though you know perfectly well nothing new is in there.
It is addictive. But that psychological reinforcement is exactly what keeps investors disciplined during a bear market. When the stock prices are flashing red, your dividend income line is usually still sloping up and to the right.
Very true.
But to keep that tracker accurate, The Saxo Bank Guide highlights 3 critical dates you have to understand. First is the ex-dividend date. Think of this as the ultimate cutoff. If you buy the stock on or after this date, you missed the boat. You get nothing for the upcoming payout.
There is nothing worse than buying a stock thinking you're about to get paid, only to realize you bought it one day after the ex-dividend date.
It is a painful lesson. The second date is the record date. That's simply when the company takes a snapshot of its ledger to see exactly who is eligible for the check. And finally, the payment date. That is the actual day the cash hits your brokerage account.
What if I'm trying to do my own due diligence before I buy? Saxo Bank actually offered a really clever trick for analyzing a company's financial statements if they don't explicitly list their total dividend payout.
It's a great exercise to verify if the cash is actually there. Think of a company's balance sheet like a household budget. You look at their net income, that's what they brought home. Then, you subtract the change in retained earnings.
What are retained earnings exactly?
Retained earnings are just the profits the company stuffed under the mattress for a rainy day or future projects.
Right.
If you take what they earned and subtract what they kept, the exact remainder is what they physically handed out to investors in cash. It cuts through all the accounting noise.
And as you're tracking all of this, the final rule from the sources is diversification. You can't just buy 5 utility companies and call it a day.
Definitely not.
You want to cast a wide net across the 5 main economic sectors: manufacturing and industry, resources and commodities, consumer, finance, and utilities. It protects your income stream from a sector-specific meltdown, and it drastically increases your odds of catching that one super stock that wildly outperforms and drives your yield on cost to the moon.
If we connect this to the bigger picture we painted today, the most vital takeaway is that a dividend is just one component of total return. Chasing an enormous payout ratio is a fool's errand if the underlying business is rotting from the inside. True, multi-generational wealth is built by identifying underlying business quality, unbreakable competitive moats, and relentless free cash flow generation.
To quickly recap the journey we've been on today, we started by looking at the sheer mathematical force of exponential compounding, where a moderate yield and reinvestment turned $100,000 into $750,000. We explored the battle-tested resilience of the dividend aristocrats and the 50-year kings. But we also acknowledged the danger of clinging to dinosaurs.
Quite the 3M lesson.
Exactly. We faced the stark reality of the tax drag that makes strategic account placement vital. And we gave you the blueprint to build a personal cash flow tracking dashboard so you can actually visualize your progress. But as we wrap up, I want to leave you with one final, slightly provocative thought to mull over.
Let's hear it.
Throughout all of these historical studies, the ultimate goal for investors has always been exponential, highly tax-efficient compounding. But we've seen how heavy the IRS tax drag is on ordinary dividends compared to the clean, deferred growth of a stock buyback. So as you build your portfolio for the future, ask yourself this: could the true dividend kings of the next 50 years actually be companies that pay exactly 0 cash dividends?
That is a fascinating question.
Could the most efficient wealth-building engines of tomorrow be companies that choose instead to perfectly engineer their stock price through relentless algorithmic share repurchases, entirely bypassing the IRS until the day you finally decide to sell? It's a completely different way to look at the future of compounding, and it challenges everything the traditional income investor holds dear. Thank you so much for joining us on this deep dive into the source material. Until next time, keep questioning the consensus, stay disciplined, and happy investing.